In this video, I will explain why I think Legal & General is the best stock on the market for a dividend investor. Then, at the end, I'll walk through a simple valuation model for the company to show why I think it's currently trading at a huge discount. What's up, guys? So let's get straight into it. Legal & General is a retirement solutions provider. The business is divided into 5 main divisions which are highly synergistic. The most profitable division is the pension risk transfer business, which in 2020 accounted for over 50% of the company's operating profits. So this is where institutions choose to offload some or all of their pension plan risk to insurance companies via annuity contracts. An aging demographic is driving the growth in this market. Legal & General currently has £1.3 trillion of assets under management, making them one of the world's largest asset managers. With a high dividend yield of over 6% at the time of filming, will the dividend continue to grow? The short answer is yes, but not as quickly as it has historically, at least not for the next few years. The previous 4 years have seen annual growth of 7%, and then the 6 years before that it was over 20% each year. After a pause in dividend growth in 2020 due to the pandemic, management has given the target of 3 to 6% annual growth for the next 4 years. This growth is lower as more cash is needed to be reinvested back into the business to accelerate growth and expansion into the US and European markets and build a presence in Japan and China. After 2024, there is no reason why the dividend growth won't return back to at least 7% annually. So, is this dividend safe from being cut? Companies with such high dividend yields are often vulnerable to cuts as they cannot afford to maintain the high dividend. I don't think this is the case for Legal & General though. Despite profits taking a hit from the pandemic in 2020, the dividend payout ratio was only 65%, meaning it was easily covered. As EPS growth is expected to be significantly more than the dividend growth for the next few years, the payout ratio will likely come down a lot, I expect probably into the 40s. The business has had a very limited impact from Brexit, so no risks due to that. The only potential risk that I can see is the very large actively managed bond portfolio, currently worth £80.4 billion. This would only be a risk if the pandemic took an unexpected turn for the worse, with a severe variant causing a large economic lockdown, meaning many companies default on their debt. Even in this event, the risk of defaults of bonds held by Legal & General remains low due to the portfolio's defensive nature. 98% of the bonds held are investment grade, and throughout the entire pandemic so far, not a single bond in the portfolio has defaulted. And finally, management have proven that they are committed to distributing a high dividend with no cuts. This was demonstrated during 2020, when because of the pandemic, the Bank of England advised all financial firms to suspend their dividend payments, which, by and large, they all did, with the exception of Legal & General, who went ahead with the £1 billion dividend payment already planned. Now, before I go through the valuation, please do hit the like button for the YouTube algorithm, it really helps. So Legal & General is currently trading at £2.85 per share with a PE ratio of 11 and a dividend yield of around 6%. I am using the dividend discount model to value the share, of which I have created 2 different versions using different discount factors. The way the model works is to forecast all future dividends paid by the company forever and discount each one's value back to the present day. Using the management guidance of 3 to 6% dividend growth, I have used 3 different growth rates for 2024. 3, 4.5 and 6%, so the minimum, middle and maximum. Then, after 2024, I assume the dividend growth returns to 7% and stays at that in perpetuity. So for example, at 3% growth, it starts at a dividend of 17.57p for the year of 2020, which is already declared, and then it increases 3% each year right through until 2024. And then from 2025 onwards, it increases at 7% per year. In the first model, the required rate of return per year is calculated by adding the expected dividend yield to the dividend growth, given 11.5%, which is then used to discount the dividend payment to its present value. The expected yield I used is 4.5%, worked out based on the dividend safety and growth prospect as previously discussed and the company's yield history. For each forecasted dividend payment, the present value is worked out The terminal value is the present value of all dividend payments from 2025 and beyond, assuming perpetual annual growth at 7%. The stock's present value is then found by summing all the present values of dividend payments for that growth. This shows us that the stock's fair value, assuming minimum dividend growth of 3% and maximum growth of 6% between 2020 and 2024 and 7% after that, is between £3.67 and £4.05p per share. The second model uses the capital asset pricing model to work out the required return, given a rate of 9.75%. This is smaller than what is used in the previous model, so the discounted present values will be higher. This puts the fair value of the stock between £5.90 and £6.59, over double the current share price today. I prefer the first model, using the yield and dividend growth to get the required return. So, in my opinion, at any point in the next 6 to 12 months, if Legal & General stock is trading at less than £4, it's at a discount. Even if the stock goes higher than £4, I'd be happy to continue adding it to my portfolio based on the stock's safety and growth prospects. I think a yield of around 3 to 3.5% is probably more appropriate. Adjusting the model to a yield of 3.5% increases the stock's fair value to between £4.70 and £5.20. That wraps up the video, guys. If you want to do a stock or dividend analysis of any other company, let me know in the comment section. See you next week.